All right, welcome. Thank you for joining us. We are very proud to be a local company run by a lot of local people. I'm the most newly adopted member of that team, 5 years in South Australia. But look, in terms of who are we, what are we doing, why do we care about it, we think South Australia is actually a very interesting opportunity in gold. So about 5 years ago, we acquired pretty much all the significant historical exploration and producing assets in the Central Gawler Craton. So we're just west of where BHP has Olympic Dam and is consolidated the IOCG province through their acquisition of Oz Minerals. That same basin that is deep and coppery goes from being deep and coppery to shallow and goldy as it heads to the west. So we consolidated this ground. We also acquired the only gold mill in the region, and the strategy was not to rush that back into operations, but to step back, build up a much larger scale strategy with a much larger destination of consequence, both in terms of value and productive scale. And so the idea now is that having built this up, we're looking at turning this on in two stages. One, leveraging that existing mill to start operations, re-rate the company both in terms of equity and credit, start producing cash flow, and then expand into our large-scale Tunkillia project, which is something we've now built up to about 1.6 million ounces of gold. So we've now reached the point where we have come out recently and said, look, the gold market has risen to meet our thesis. We're aiming to start our stage one operations next year in 2026. Get that cash flow going, and we are now also accelerating the development programs for Tunkillia. So coming up for us, we're getting ready to publish an optimized scoping study for Tunkillia. It's a very advanced optimized study. We will then be starting to accelerate some of the mining lease application programs and early feasibility work. And then we're also going to be coming out with our plan to start our stage one operation during 2026. In terms of our capital structure, pretty simple, pretty clean. We've got about 219 million shares on issue, right around an 80 million Australian dollar market cap, or around 70 million enterprise value. And really the key thing for us is sort of the strength of our register. We've really seen this consolidate into the hands of sort of family office, high net wealth, and institutional investors. And they're really consolidating around two things. One, very strong board and management alignment. Board and management own over 20% of this business. And two, really consistent, really steady progress, advancing these assets towards a realizable, de-risked outcome. And one of the key things that we do there actually is we generate capital internally. So when we've been doing all of this over the past 4 years, we've only raised about $9 million publicly since we IPO'd 4 years ago. And what this means is we've had very little dilution while making all of this progress. So we take very good care of our shareholders. We are the largest shareholder. We are perfectly aligned with you. And so we've seen a really strong sort of recognition of that in the market. One of the key things for us, or probably the key thing when we're talking about the capital structure, is our human capital, right? So you can't go past this. Mediocre assets, great team is going to outperform great asset with a terrible team. We've built a team that is not only local, South Australian, very passionate about doing something big in this state, but has a very strong pedigree both in gold and South Australia. So our leadership team have got about 300 years of experience exploring for, finding, permitting, building, and operating major mining assets. About half of our leadership team come from Normandy Mining, which is a name many of you will remember, the largest gold producer in the Southern Hemisphere in the 1990s until it was acquired by Newmont in 2002 at around a 2.5 million ounce per annum producer. So we've got a deep deck in the team of capabilities. And what are we trying to do with this? Again, so let's put this on a map. These are our assets. We group them into what we call our stage one assets and our stage two assets. Now, we focused for the past 4 years on building up that sort of large-scale destination. So we focused on that Tunkillia project down in the southeast, which we call our sort of stage two expansion area. That's something that we've built up to 1.6 million ounces of gold and now 3.1 million ounces of silver as a formal resource. And we've now put that through an initial scoping study to see how that looks in operations, and that's what we're working on optimizing now. But we also have this collection of assets to the north and northwest. And up in the northwest, we have our Central Gawler Mill. That sits adjacent to the old historical underground Challenger mine. We also have the Tarcoola project. And this is where South Australia had its gold rush in the late 1800s. So we're now shifting our attention back up to this stage one area and saying, hey, the market has met our thesis. Now we're going to go and look at leveraging this stage one operation. So now what we're doing is we're looking at the mill, we're figuring out how we want to reconfigure that mill, how we want to get it started, what's all the mineralization around the mill, what are all the Lego pieces we're going to play with. We're going to come back to the market in a couple of months and say, here's the plan, here's what we're doing, and here is now, with these two assets, the 15-year pathway into operations from 2026 and 15 years of production and growth. The reason why we focused on our stage 2 expansion plan first is we are really focused on the efficiencies of scale here. So we profile a company called Capricorn Metals. I don't think this is going to be a strange name to any of you. Capricorn really sort of exemplify the sort of the merits of focusing on capital and operating efficiencies of scale. And they bought an asset called Karlawinda back in 2015 as a 650,000 ounce asset and grew it to 900,000 ounces and 1.1 and 1.3 and 1.5 million ounces. And then they focused on developing that as a bulk efficient open pit operation. Now today they've grown that up to about 2.2 million ounces of resource, and it's a 0.7 gram resource grade, which is something that in Australia people typically go, oh, it's so low grade. Yes, but processing 4.5 million ton per annum, they are among the lowest cost gold producers in Australia and in the world. So efficiencies of scale work. And when we were looking at Tunkillia, we saw some similarities in the geometry of the mineralization that we thought was very attractive. So we acquired our asset about 5 years later, just at the end of 2019, early 2020. We bought it as a 550,000 ounce asset. We grew it to 900,000 ounces. We found 5 new gold zones, and we grew it to 1.1 and 1.3 and 1.5 million ounces. We've now grown that just up to 1.6, but we've also focused on a bulk efficient operation, targeting capital efficiencies of scale in both operating costs and capital costs. And what we're looking at when we look at Tunkillia is essentially broad mineralization running along the western margin of a very large shear zone. So the key point of this project and what we're looking at on this map here is a mineral endowment that is much, much larger, as we've demonstrated, than has historically been recognized. So it's something that we've been able to grow quickly. We've been able to leverage a lot of historical data. We've been adding ounces here for about 15 Australian dollars per ounce. And we really only just scratched the surface of this shear zone. We've got another 20 kilometers of untested shear here, but we know now that we have a very strong economic base with this project. And when we ran our initial test of this project, this is a study we published in July of 2024, the idea here was to say, well, these projects are systems and series of equations, right? So you have to start fixing some assumptions, running your test to figure out how this all works. So we fixed the assumption of scale at 5 million ton per annum. And then we solve for CapEx, we solve for OpEx, we solve for mine design. And what that gave us was a very attractive result, producing around 130,000 ounces of gold per annum and 300,000 ounces per annum of silver. Importantly, at an all-in sustaining cost of around 1,900 Australian, which would put you today in operations in the bottom cost quartile, both in Australia and globally. That coupled with an initial sort of an equity IRR of 40% unlevered and a 1.9 year payback said, okay, this is really interesting. Let's scratch deeper. One of the key things to understand about these results is that all-in sustaining cost is already efficient, but we made some very conservative assumptions when we did that. We assumed the material was much, much harder than it actually is. And we also assumed a very inefficient crushing and grinding methodology. So we sort of inflated artificially the power costs and the power consumed to do this. So now what we're looking at doing is optimizing the comminution circuit, bringing back those power costs, looking at different power solutions, taking those savings and pushing them out into the mine design. And the idea is that we want to turn this into something that looks more like a sort of 8 to 10 year style operation over time, but something where we're going to stay in that bottom quartile of cost and create a really nice, attractive financing, but also hopefully future dividend platform. So we're accelerating a lot of the studies that will push us into feasibility and mining lease applications. And one of the key things to understand about this and why we get these interesting results is sort of the geometry of the geology, if you will. So when you look at the main body of mineralization here and you look at a cross-section through the middle, the thing that really drives this fast payback and these really interesting economics is this higher grade central zone. So this is one of the first things we set about proving when we bought this asset. And what you can see in the mineralization here, so we cut off our resource estimation at about 300 meters depth, but 80% of the tons and ounces are within 200 meters of surface. So there's a slight bias towards shallow, if you will. But there's also this higher grade zone in the middle. And what you're looking at in that cross section is 80 to 100 meters of width in terms of the mineralization. So this is a very broad working face on the floor of an open pit, very bulk, very efficient, within which there's anywhere between 10 to 30 meters of higher grade mineralization grading between 2 and 10 grams per ton in the block model. This has the effect of pushing up the average grade in that initial starter pit. And so when we actually break out the sort of economics of what does that starter pit mean, what does it do, within the sort of life of mine economics. We've sort of put two columns of data here on this slide that you can see, and you can see in yellow here, that sort of yellow outline is that starter pit. This is a very important sort of lesson in the sort of horsepower versus torque of sort of the capital economies of scale, large mills. Our life of mine average production, 130,000 ounces per annum at a cash cost of around $1,900 Australian with a head grade of 0.93 grams. So you see the efficiency of that type of a scale, that type of a mill. But when you look at that starter pit, that first 5 million tons has a slightly higher grade of about 1.26 gram per ton. And what that means is the first 5 million tons is not producing 130,000 ounces, it's producing 180,000 ounces. So your average cash cost of producing those ounces, pushing 5 million tons through the mill, is not $1,900 per ounce Australian, it's about $1,200 per ounce Australian. So you're generating at a $3,500 Australian gold price, which is of course $1,500 below where it is today, you're generating $400 million in gross free cash from your first 5 million tons. So this is a very attractive financing profile for banks. Then when we look next door, so Tarcoola, this is our project that sits in the middle. What we're looking for here is higher grade, shallow, smaller bodies of mineralization that can both go through our existing mill today and also blend in, create some more of these interesting higher grade starter pit style economics at that Tunkillia project next door. So this is the home of high grade gold in South Australia. It's where South Australia had its gold rush in 1893. There are about 600 historical workings on our exploration licenses and mining lease there in the southwest. And then in 2016, a small open pit was dug there that was feeding our existing mill. Now, we've actually been focused on building up a new structural model in this gold field while building up sort of that large-scale platform at Tunkillia. The existing mine is interesting. It's really instructive as to what is the potential of shallow, high-grade mineralization in this gold field. So that mine's only about 60 meters deep at its deepest point. We've added about 20,000 ounces of gold into the pit floor. We've done some more drilling. There's more mineralization. Everything that's in gray is mineralization, but not yet classified in JORC. The idea here is we can try to look at putting 30, 40, 50,000 ounces on this pit, and that can go and start feeding our existing mill for our stage one operation. But what's more interesting when you consider sort of the wealth of what came out of this pit in the past, and that void there, that sort of shallow, short pit produced somewhere around sort of 50 to 60,000 ounces historically between open pit mining and the historical underground mining there. When you step out and say, what's the potential for this to repeat in this gold field? Again, while building up Tunkillia for scale, we spent a lot of time mapping what does that gold field actually look like underground. So we did a whole bunch of new geophysical and geochemical studies. We did new seismic studies. We were able to get really interesting seismic signatures off the basin there. And we mapped a couple of dozen structures that run parallel and cross-cutting to the structure that hosted that really high-grade pit. And this effectively was the first time in 130 years of high-grade mining in this gold field that you could actually see what the subsurface architecture looked like. So we went and drill tested a bunch of these, and one of our favorite targets was Tolmer, and we've now confirmed both a new high-grade gold-silver prospect there, and quite interestingly, just on the shoulder of that, we've found some freakishly high-grade silver. So when you look at that silver discovery, this was follow-up drilling we did, having found some interesting high-grade gold. Just a couple hundred meters off to the left, we've now picked up an intersection of 6 meters at 4,747 grams per ton. To put that in very simple context, that's the highest grade silver intersection on the ASX for the first 3 months of the year, and top 10 in the world for Canada and ASX. So it's not something that we would have expected to see in that sort of extremity of grade. It's definitely eye-opening. For us now, we have an interesting sort of activity schedule set up to go and follow this up and see exactly what this is, because obviously we're very interested in high-grade gold, but we're also quite interested in high-grade silver that could perhaps also blend into our Tunkillia gold and silver project. So for us, the next 6 months are really going to be about essentially crystallizing the plan and pathway for both of these stories, bringing them down, landing these, and showing the market, here is the exact plan for stage one, here is the exact plan for stage two, here's how they come together, and here's how we invest a little bit of money in stage one to start production and kick off this 15-year production and growth pathway. So in thinking about Barton Gold, we think we've put together a pretty unique platform. a strategy that can really leverage that existing infrastructure. I dare say, I think we're pretty reasonably valued for a company that can step into production at will on a fully licensed, fully permitted mill. We've got the leadership and experience to deliver this. So thank you very much, and happy to answer any questions at our booth.